Okay, in this video, I just want to talk a little bit about absorption and variable costing. And I do think that the tutorials in your textbook are very adequate and very comprehensive. One thing that it does leave off is a thing called the reconciliation of these two methods. I don't know in practice or why we would need to do a reconciliation, but it is a way of knowing that your variable costing, operating income, and inventories are properly stated as compared to absorption, which is what really comes out of an income or comes out of an accounting system, is that it's always designed to be sort of absorption costing based. Okay, so we know a few things about absorption costing. We've been using absorption costing since the beginning, and I think I've alluded to it a couple of times. So absorption costing is really just the absorbing of direct materials, direct labor, and all of manufacturing overhead that pertains to the production process. So that has become what we know as the manufacturing cost or product costs under absorption. So really think of it as a big ball of costs that go up into work in process and then over into finished goods. And from finished goods, it gets sold off, right? And it goes right down to cost of goods sold. So really, just like a merchandising business, when we talk about merchandising, we're always talking about the net income, but we always talk about it in terms of the cost of goods sold. If cost of goods sold goes up, net income goes down. If revenues go up and cost of goods sold stay the same, well, income goes up, all kinds of that. So, I mean, we can see it because we've been using it for so long now. So just think of it as a big ball that goes up to work in process, over to finished goods as cost of goods manufactured, and then down into the income statement through cost of goods sold. So we're really just talking about inventory valuation and cost of goods sold, which consequently affects our operating income. So under absorption costing, it says the following costs are treated as period costs. Now, administrative costs, fixed and variable, are always period costs. They're always going to be down in the income statement in the period in which they are incurred. So if nothing else, we're just really need to focus on variable costs. So a study technique here would be to focus on variable costing more than absorption costing. However, your author does position this chapter right after the conversation about break even, which uses what's called the contribution margin approach. And the contribution margin approach is variable expenses above contribution margin and all fixed costs below contribution margin. That way we can do analysis really quick and make some decisions fairly easily. And that is definitely an internal type of income statement. It's not one that you're going to produce and send out to your stockholders. Okay, so variable costing is an alternative to internal management or for internal management reports. And again, here, think of that big ball now just shrunk down by the amount of fixed manufacturing costs, like depreciation, like rent, or a lease, or anything like that. So the ball got smaller, so a smaller ball goes up into work in process, and then over to finished goods, and boom, it comes down. So what happened to all those fixed costs? Well, they were just pushed down into the income statement on the date that they were incurred, just like other period costs. So in other words, the fixed manufacturing costs that we were suspending and putting up through work in process now just goes down to the income statement and is reported as a cost in the business. And consequently, you can probably get an idea without even talking about whether sales exceeds production or production exceeds sales, and say, okay, now that more costs are going down in my income statement, the longer my inventory is suspended up here in variable costing, the lower my net the lower my net income is going to be for a period of time. But you must understand one thing: variable and absorption costing are equal. The only reason that they appear to be different at any one given time is because of time. So it's like a bank account. A bank account you always have to reconcile a bank account to your books and the bank's balance. Well, what if you didn't do anything for a month? And if you kept good books, the balance in the bank will equal the balance in your books. only during that magic time that you don't do anything at all. In the case of this costing system, what has to happen is, in order for them to be equal, is to have no beginning inventory and that production equals sales. In other words, or sales equals production. So you produce and sell exactly that amount. In other words, your work in process is empty, your finished goods is empty. And for that moment of inventory, we've got zero inventory, it's all down in the income statement, isn't it? So there, from that point, variable costing and absorption costing are exactly the same. So here, I'm just going to be putting this up with this video, and you can take a look at this. You can see how all the costs go into work in process under absorption costing, and all selling always is treated as period costs, always period. But notice that the fixed manufacturing overhead in the case of variable costing goes down and is treated as a period cost as well. Okay, so that's the end of this video. I'm going to bring back a little example. I'm going to use a template with all of its warnings, but you'll get to see in a quick instance how variable and absorption can be different, and then how we do a little reconciliation to make sure that we've done it correctly and just what the differences are. So we'll be comparing. Okay, so I hope this video helps, and we'll see you in the next video.